Very good afternoon, all of you. Hope you all are doing good. May God bless you all. Welcome to Commerce first year classes. Yesterday we have learned two LAQs, that is sole proprietors, features, advantages, disadvantages, and one more, partnership, features, advantages, and disadvantages. Let us move further. Hmm. Yeah. Today we'll take what is joint stock company, what are its advantages and disadvantages, or we learn features. Okay. What are the features? What is joint stock company first of all? Unlike proprietorship or partnership, okay, the very important feature is unlike proprietorship or partnership, a company, a joint stock company has a separate legal existence. It has a separate legal existence. That is, I told you yesterday, suppose there is a proprietary firm, Galaxy Mobiles, and the proprietor is Mr. Rao. So, in the eyes of law, Galaxy Mobile does not exist. Mr. Rao is the whole and soul of Galaxy Mobile, right? Mr. Rao, a natural person, has existence, but Galaxy Mobile does not exist in the eyes of law. Same is the case in case of, same is the provision in case of partnership firm also. Firm does not exist, the partners exist. But in case of a company, I'll give small example. Suppose we have Reliance Industries Limited. One of the owners is, let us say, Mr. Ambani. Mr. Ambani. And suppose Reliance wants to open an outlet. Reliance Industries want to open an outlet. They selected one place in Mehdipatnam area somewhere. And that owner is Mr. X. They have to sign an agreement. They have to enter into an agreement. Will the agreement be between Mr. X and Mr. Ambani or a company? It is no. If it is a proprietary firm, yes, it has to be between Ambani and Mr. X. But in case of a company, the agreement will be Mr. X and Reliance Company. Reliance Company, because as I said, a company is having a legal existence. It is an artificial person created by law. It can enter into contract. It can sue somebody. It can be sued by somebody, right? Though it is not having a physical existence like we have, like me. I'm a natural person. We are all natural persons. We do have natural and physical existence. But a company has no physical existence. It does not exist naturally. It is artificially created by law. So that is a very important feature of a company, right? Now, let us see what are the features of a company. The first feature is its membership, right? Now, broadly, a company is divided into two types. One is a private limited company and the other one is a public limited company. We do have many classifications. We do have many types of companies. We do have many types of companies, but broadly, we have a public company or a private company. So when it comes to membership, like if you remember, I told you in case of sole proprietor, only one person, only one member. In case of partnership, minimum 2, maximum 50, I said. Similarly, in case of a company, if it is a private company, they have to have minimum 2 persons and maximum is 200. In case of a private company, minimum 2 members and maximum 200. In case of a public limited company, minimum 7 members and maximum unlimited. They can have any number of members. We are discussing the membership of a company. I said, if it is a private company, minimum members are 2 and maximum members are 200. If it is a public company, minimum members are 7 and maximum members are unlimited. Second feature is artificial person created by law. Just now I told you. What is a company? It's an artificial person created by law. That is, it exists only in the eyes of law. Does it exist naturally like me? I'm a natural person. I have physical existence. I do exist naturally. I move here, I move there. Can a company have such existence or activity? Answer is no. It is created only for legal purpose. And as such, we say that a company is an artificial person created by law. And next is, it has a separate legal entity. Like the example I gave here. If it is a proprietary firm, we cannot file a case against the firm. The customer, if he is deceived, if he is cheated by a mobile shop owner, then the customer cannot file a case against the shop. He has to file a case against the owner of the shop, the proprietor of the shop. Why? Because, as I said, a proprietary firm and a partnership firm do not have separate entity. They are known by their owners or partners only. But when it comes to company, see, if any problem occurs, we will not directly call Ambani. We will call Reliance Company, isn't it? Because Reliance Company is having a separate entity. It is having legal existence and it exists separately, away from the proprietor or away from the owner of it, let us say. Next, formation, right? Formation. The formation of a joint stock company is not as simple as proprietorship or partnership. I told you, at the time of saying proprietorship and partnership, easy to form, easy to wind up. But in case of a joint stock company, we have to have produced, or we have to draft, or we have to present several documents. Like there are few which we'll learn later: memorandum of association, article of association, prospectus. These are the documents which we have to prepare and submit to a body called as ROC, registrar of company. And then we have to fulfill a number of legal formalities. We have to pay all the fees. Then only it comes into existence. And all these companies, whoever is getting registered, are governed by the provisions of Indian Companies Act 2013. All the companies registered in India, I repeat, all the companies registered in India are governed by Indian Companies Act 2013. See, if it is a partnership firm, I told you, if it is a partnership firm, all the partnership firms are governed by Indian Partnership Act 1932. All the partnership firm in India are governed by Indian Partnership Act 1932. Likewise, all the registered companies in India are governed by Indian Partnership Act 1932. 2013. Indian Companies Act 2013. It is here, you see. Huh? Right. Then, common seal. Very important feature. See, I am a natural person. Okay. There are two natural persons. If they enter into any contract, they can sign. Right? If I am entering into contract with somebody, I can sign. Right? But a company, if it is entering into a contract, as the company is not having physical existence, it cannot sign, no? It cannot sign. So, like, again, we'll take this case only. This is a contract between Mr. X and Reliance Company, let us say. They have entered into a rental agreement. Mr. X is the proper owner of a property. He is having a property in Mehndipatnam area, which he wants to lease out to Reliance Company. So, when the rental agreement is drafted, Mr. X can sign. Both the parties have to sign, no? You might be knowing, whenever any contract is entered into, both the parties should sign. So now Mr. X is having physical existence, so he will do the signature. But when it comes to the second party, who is the second party? It is Reliance Company. So can Reliance Company sign? Obviously no, because it has no legal existence. So instead, what do? We put a seal here. We put a, let us say, stamp here, and that will be countersigned by one of the directors of the company. So common seal is a very important feature of any company. But then, well, okay, as far as IP is concerned, let us say it is one of the important features. Okay, so common seal, I said. Next, perpetual existence. Perpetual means permanent. Perpetual means continuous. Again, remember I told you, in case of proprietary firm, yesterday I gave that example. The is proprietor has started a business and he is continuing the business. But later on, his two children, they both learned, they became engineers and they wanted to do the job. So obviously, what will be the fate of the firm? What is the fate of the shop? It has to be closed. Similarly, in case of partnership, we have seen yesterday, if there is any difference of opinion, if there is any rift, either a partner leaves or he can call for dissolution of the firm. Even in that event, the firm has to be closed. The firm will come down. The operations will be closed. But it is not the case in case of a company, because in case of a company, since there are so many members, members may come and go, but the company will continue to exist. The admission or retirement, the incoming or outgoing of any member will not affect the existence of company. Members may come or go, but the company will continue to exist unless it is winded up, right? Then, limited liability of a member. This is a very, very big advantage of a joint stock company. Limited liability. If you remember, I told you, in case of proprietary firm and partnership firm, the liability of members is unlimited. The liability of members is unlimited there. What is that? If you recall, if the firm incurs huge losses, then the proprietor or the partners have to dispose of their personal property to pay the debts, isn't it? They cannot say that business mein loss ho gaya, we will not be paying it. They have to clear the debts in the market. But in case of a company, suppose I purchase shares of a company. Let us say we have one person, Rao, he had purchased shares of one company. Let us say he purchased shares of Wipro company, right? He purchased shares of 1 lakh. He purchased shares of rupees 1 lakh. And let us say, not name the company, better. We'll take, let us say there was some X Limited company. There was some X Limited company and Mr. Rao purchased shares of X Limited company. That company went into huge losses. So can this company ask for more money from from Rao? Answer is no. Rao is liable only to the extent of shares held by him. His liability is limited only to the value of shares held by him. Okay, he had invested 1 lakh rupees, so his liability is only 1 lakh. The company cannot call for more money because the loss is huge, isn't it? That is one very, very big advantage. I say again, what is it? Limited liability of the shareholders. Limited liability of the shareholders. Next is transferability of shares. In case of public company, see again, yesterday I told this example, no, partnership, the shares cannot be transferred. If Mr. A says, I want to move away and this place will be taken over by my son, not acceptable. But here it is not like that. Suppose Mr. Rao is owning some shares. He's having, let us say, 2,000 shares. He's in need of money. He wants to sell it to B. It can be done. Later, B want to sell it to C. It can be done. Later again, C want to sell it to A. It can be done. Shares can change hands. Easily transferable. The ownership in case of a company can be easily transferred from one person to another person. That is transferability of shares. Okay. So this can happen only in case of public company. In case of private company, there are some restrictions if you see. But in case of private company, some restrictions are imposed for transferring shares. Though it is not impossible, but there are certain restrictions in case of private company. Okay. Then democratic management. What is democracy? All are equal. India is a democratic country. All are equal. Every individual, irrespective of financial position, social status, we all are treated equally. See, there can be a small-time businessman or there can be a beggar. If he is having voter ID, he'll get one vote to cast. Similarly, suppose there is big shot or big businessman. Okay, since he is having hundreds of crores rupees, will he be given two votes to cast? Answer is no. Whether it is any big shot or any beggar, everyone is equal in the eyes of law, and he is allowed to cast only one vote. So that is said to be democratic management. So here also democracy is there in case of company. All the shareholders are equal, but only so see the directors will be appointed like we do appoint representatives, no? In the same manner, in a company, shareholders will appoint directors. Those directors will represent the rest of the shareholders. A company can have, I said, unlimited this thing. A public company can have unlimited shareholders, unlimited members. Now imagine a company is having 10 lakh shareholders. Will all the 10 lakh shareholders go to office daily? Will they go to company? No, they are not allowed to also. So who represent them? The directors will represent them. And these directors are appointed by the shareholders. Okay. So, and we have a democratic management. Next, statutory regulations. Statutory means the one which are issued by government. Statutory rules are the ones which are issued by government. So in case of a in case of a company, all the regulations are to be strictly followed by a company. Okay, all the rules and regulations issued by the government or the Companies Act, they are to be followed by all the companies, registered companies. Okay, so then, so these were the features of a joint stock company. Again, this is also very important. We learned three answers. One is advantages, disadvantages of sole trader, advantages, disadvantages of partnership, and then features of joint stock company. Three are important. Now let us go to the next question, that is distinguish between, I told you, no, broadly speaking, companies are divided into two. One is private, one is public. Very important question. Again, this is also. Okay. Let us see the differences. Let us see what is the difference between a private company and public company. Okay. वैसे तो there are many classifications. Companies are classified into many categories. Broadly, we have private company and public company. Now, talking about private company, first point is a private company minimum paid up capital should be 1 lakh. Minimum member should be 2. Maximum member should be 200. It is not allowed to issue shares to public, and it is not allowed to transfer shares. Whereas a public company has minimum paid up capital of 5 lakhs, minimum members are 7, unlimited members, maximum members are unlimited, and public limited company can issue shares to public. Those are easily transferable. Just now we have learned, no, transferability of share in case of public limited is easy, but in case of private limited company, there are some restrictions. Now, we will learn this in tabular form. We will learn the differences in tabular form. Okay. You draft the same way in exam also. Just the table. Easily you can get 10 marks. Again, let us learn it here itself. See the 9 points, the introduction part, and 9 points. It will fetch you 10 marks. This answer will fetch you 10 marks. So what is the first point? It is regarding members. The difference in membership in case of a private company and a public company. In case of private company, they can have 2 minimum as members, 2 members as minimum, and 200 as maximum. A private limited company can have 2 members as minimum and maximum 200. Whereas a public limited company has to have 7 members as minimum, and its maximum, there is no limit. A public limited company, say Reliance company, Tata company, Wipro company, Hindustan Liver, all these are public limited companies. They can have any number of shareholders, any number of members as their shareholders. There is no capping on the maximum size. Minimum is 7. So point number 1, private limited company, minimum 2, maximum 200. Minimum 2, maximum 200. Public limited company, minimum 7, maximum no limit. Minimum 7, maximum no limit. Then point number 2, transfer of shares. In case of private limited company, shares cannot be transferred. Shares cannot be transferred, or there are many restrictions if the shares are to be transferred. So it is better, let us say that transferability of share is not allowed in case of a private company. But in case of public company, shares can be easily transferred. Shares are freely transferred in case of a public limited company. Next is public invitation. Public invitation means, can a private, see, how many members are there in case of private limited company? In case of private limited company, maximum members are 200, I said. Okay. Suppose this is X private limited. This is a private limited company. They are having, let us say, 120 members. This company needs a finance of 10 crores. Where from they'll get this 10 crores will be contributed by these 120 members only. They have to get that amount. Whether it is 120 members or 150 members, 180 members, as many members, they will contribute the total capital required by a private limited company of, let us say, 10 crores. Can they ask the amount from public in the form of shares? No. They can approach a bank and take loan. But can they issue shares to public? Answer is no. So a private company is not allowed to issue shares. They cannot ask the public to subscribe for their share capital. The entire share capital will be managed by the members of the private limited company. But in case of a public limited company can invite shares from the public. It can invite the public for subscribing their shares. So all these companies are there, no? Like I again say the same example, sir. Reliance is there, Tata is there, Wipro is there. All these companies will raise their fund through issue of share to public. They are allowed to know. They are a public limited company, so they can issue shares and raise finance. So they issue shares to public because they are allowed by the provisions of Indian Company Act 2013. Then name. How should the name of a private limited company appear and how should the name of a public limited company appear? I told you just now, I gave example. I wrote X private limited because if it is a private limited, it should be written like this. X is the name of the company, or let us say there is some other name, ABC private limited. So by looking at the name, we can make out whether it is a public company or a private company. The example I gave here, ABC, is it a private company or public company? Answer is, it is a private company. Suppose I write ABC, public limited, then it becomes what? It becomes a public company. So the only thing is, if it is a private company, we write the word private. If it is a public company, we write the word public. Right? Sorry. Here it is. Private limited, public limited. Right? That. Number of directors. I told you just now who are the directors. Directors are the person who represent the shareholder. Like we have we have the representative, electoral representatives in democracy. We have MLA, MP. Okay. In the same manner, shareholders are represented by the directors of a company. So if it is a private company, there the minimum number of directors are 2 and maximum they can have any. They can have any number of directors in case of a private limited company, but in case of public limited company, minimum 3 directors, maximum 20 only. I repeat, in case of private limited company, minimum directors are 2 and maximum directors are unlimited. Unlimited means we can understand one point where the maximum membership is 200 only. So obviously it cannot be beyond 200, but then there is no limit. They can have any number of directors. But a public limited has to have 3 as the minimum directors and 20 as the maximum directors. Right? Then minimum paid up capital for a private limited company, we studied no at the beginning as a part of introduction. Minimum paid up capital is 1 lakh, and for a public limited company, minimum paid up capital is 5 lakh. Go through that point. Minimum capital 1 lakh for a private limited company, and minimum capital 5 lakhs for a public limited company. Then similarly, what is the maximum? What is the maximum? Can have any amount, no issues. Then remunerations of director. In case of private limited company, there is no restriction on the remuneration of director. In case of private limited company, there is no restriction on the remuneration of directors. Director can take any salary. See, limited members, the public amount is not at stake. Okay, पब्लिक का पैसा दांव पे लगा हुआ नहीं है, वो 200 मेंबर कंट्रीब्यूट करके कंपनी चला रहे हैं, उन्हीं में से कोई लोग डायरेक्टर्स बनते हैं और वो लोग चाहे जो भी सैलरी ले लो, it's not going to affect the general public. But in case of a public limited company, आम लोगों का पैसा दांव पे लगा हुआ है, because general public will subscribe to the shares of a public limited company. So there are restrictions on the remuneration of directors. In case of a public company, there are restrictions on the remuneration of director, but in case of a private limited company, there are no restrictions. They can take any amount of salary. Then commencement of business. When can the business be started? A private limited company can start the business after getting the certificate of incorporation. There are two certificates. One is called certificate of incorporation and the other one is called certificate of commencement. Certificate of incorporation and certificate of commencement. So a private limited company can start business after getting certificate of incorporation, but a public limited company can start business after getting certificate of commencement. So between this certificate of incorporation and certificate of commencement, there are some activities which are to be undertaken by a public limited company. And what is that activity? It is the issue of prospectus and inviting the public to subscribe their share and all this. Right? So for you, it is enough to know that a private limited company can start the business after getting certificate of incorporation. But a public limited company can start the business after getting certificate of commencement. Then appointment and retirement of a director. In case of private limited company, it can be done by a simple resolution, single resolution. But here, a special resolution is to be done, passed. Right? Again, it's about appointment and retirement of directors. In case of private company, private limited company, appointment and retirement of a director can be done by passing a simple single resolution. But in case of a public limited company, it has to have a separate or a special resolution, let us say. Okay. Hope you all understood this. Go through once. 9 points, 10 marks. A very good bet. Then, moving forward, we have next important question, that is, I'm not taking the advantages and disadvantages of joint stock company because we have learned features. From the features only come the advantages and disadvantages. Instead, I'll take one very frequently asked question. What is memorandum of association and what are its clauses? What is memorandum of association and what are its clauses? So the next important LAQ, what is Memorandum of Association? Explain its clauses. See, every country is governed by the provisions of its constitution, right? We have rights and duties. In India, all the citizens are having rights and duties. Who has given us those rights and duties? The rights and duties are mentioned in the Constitution of India. So for every nation, we have a constitution. In the same manner, for every joint stock company, we have a constitution. That constitution is called as Memorandum of Association, or it is also called as Charter of the Company. It is also called as Charter of the Company. So very simply speaking, for a nation, it is constitution. And for a company, it's Memorandum of Association, MOA. So what is this MOA? What is its definition? And what are the contents of MOA that we will learn today? What are the clauses written in MOA? Memorandum of Association is the constitution of company, as I said. It is also known as Charter of the Company. It provides the foundation of the company on which its structure is built. What is the purpose of forming a company? That is mentioned in Memorandum of Association. What is the scope of the company? What are the spheres that are covered by the company? All these things are mentioned in Memorandum of Association. Okay. And there is a definition given by Keynes. According to Keynes, a Memorandum of Association is a charter which defines the limitations and powers of the company. He said, a Memorandum of Association is a charter which defines the limitations and powers of a company. The MOA must be signed. Again, this is a very important point. The Memorandum of Association must be signed by 7 members in case of public limited company and 2 in case of private limited company. Every private limited company will have 2 members who sign the MOA and 7 members who sign the MOA in case of a public limited company. Now, what are the clauses of MOA? What we are learning is, what are the clauses of MOA? Yani, what all the conditions or contents of MOA? The first clause is name clause. The first one is name clause. First clause is name clause. See, every company has to have some name, no? Like every person has to have some name. In the same manner, I told you, while telling you the features of a company, every company is an artificial person. So every person should have a name. For correspondence, for identification, we need to know or we need to have a name. So every company should have a name. That name will be given to that company by ROC. So they have to submit to ROC. So what is the first clause? It is the name clause. In the Memorandum of Association, what is the first clause? It is the name clause. Here, since a company is a separate legal entity, it has to have a name. And that name will be selected by the promoters of a company. They will submit it to ROC and ROC will allot the name. And it is said that while choosing the name, they should avoid the names like king, queen, or name of any government body in the name of a company. While choosing the name of a company, we cannot use the words king, queen, or any government body or government agency's name. Okay. So, and it is said that at the time of submitting the names to ROC, they are asked to submit 3 different names. It is said that they should submit 3 different names. Suppose I want to keep the name of my company as A. So I should give A first preference, and then again I should give B, and I should give C, 3 preference. Suppose I give A as my first preference, but there is already a company by the name A. So this will not be allotted to me. I'll be allowed B, like this. So at the time of submitting itself, it is advised or it is asked that we should submit 3 different names. Whichever is available, ROC will allot that name. And when we know that already there is a company existent by that name, we should not give such name. Like suppose there is Reliance Industries Limited. Can again somebody have that a company by that name? Answer is no, because it is already an existent company. So you cannot go with the same name again. So while choosing the name, it is asked that take the name which already does not exist, and also you should give 3 different names. Next one is registered office clause, or this is also called as location clause. So while writing the MOA, we have to mention the address of the office. The registered office address should be mentioned in the name or in the MOA. But suppose at the time of you drafting the MOA, like at the time of you drafting the MOA, your registered office is not yet finalized. It happens, no? You are drafting MOA, but still the place is not finalized. Then it is said that after getting the certificate of incorporation, within 30 days, we should submit the name of the address of our registered office. We should give the name while drafting the MOA itself. But for some genuine reason, if you are not able to, then within 30 days, right? And why do we need this? This is need by ROC for correspondence purpose. If the company wants to, if the ROC wants to do some correspondence, some letter, send some notice to the company, there has to be an office, no? There has to be a postal correspondence. That is the purpose of mentioning the registered clause in MOA. Next is object clause. Very, very important. Very, very important. The clause defines the sphere of activities of the company, and this may be considered as the core of MOA. The very basic, the very foundation of why the business is started is mentioned in object clause. Like suppose I want to start a company which manufactures mobiles. So in my object clause, I have to mention manufacturing of mobile, right? But suppose at the time of drafting my MOA, I have drafted that I want to manufacture mobile. But later, due to some reasons, I did not start manufacturing mobile, but I am manufacturing some other pens, let us say. Manufacturing pen. Then it is treated as illegal. This is treated as illegal. Though manufacturing pen is not illegal, but since it was not mentioned in my MOA, it will be treated as an illegal business. So we have to be very careful when we are drafting our MOA, especially when we draft the object clause. That is why it said that it is the core of MOA. So what do people do when they are drafting this object clause? No, they mention around 8 to 10 or 10 to 15 different businesses, though they are not interested in doing, but you do not know tomorrow you may start any of this business. So to be on the safer side, they do mention it. But see, once it is done, later if you want to start another business, you cannot change it. It's not like that. You can alter memorandum of association, not an issue. But then it is a very critical process. It's a very difficult process. That is why every businessman, what they do diplomatically, before they start the business, while they are drafting object clause, they mention 10 to 15 businesses. Okay, so that is object clause. Then liability clause. Now liability clause mentions very clearly the liability of shareholders is limited to the value of shares held by them. This will be mentioned in the liability clause. It is very clearly mentioned that the liability of shareholders is limited to the value of shares held by them. Right? So they're private. Okay, I'll elaborate it and tell you. See what is written here. It means that the members are liable to pay only the unpaid balance of their shares, no further else, not further else. It means, suppose there is one person who had purchased 1,000 shares of a company at, let us say, 10 rupees, the value is 10,000. Okay. And he has paid, let us say, these 10 rupees, they will call in installments, not the total 10 rupees. Let us say they have called 7 rupees. So he has paid 1000 into 7,000 rupees he has paid. And he still has to pay 3 rupees per share, that is 3,000 rupees. Right? So now the clause means his liability is how much? His liability is 10,000. So he cannot say that I have paid 7,000, I will not pay 3,000. No. His liability is to the face value or the value at which the shares have been issued. The shares were issued at 10 rupees, so his liability is 10 per share, not 7 per share. So he is liable to pay this extra 3,000 rupees also. The remaining balance he has to pay. Okay. Next is capital clause. In the capital clause, the company will mention the capital structure. Now, what is capital structure? Say a company is going to issue totally, let us say, 50 lakhs as share capital. They are going to issue 50 lakhs as share capital. Out of these 50 lakhs, see, there are two categories of shares. There are two types of shares. One is equity share. One is equity share. The other one is preference share. I said they want to issue 50 lakhs worth of shares. And out of that, 40 lakhs are equity shares and 10 lakhs are preference shares. This they have to mention in the capital clause. In the capital clause, they have to mention the different category of shares and their value, or how much equity shares or how many equity shares and how many preference shares they are going to issue. This has to be mentioned. The division of total capital into equity share and preference share, that has to be mentioned in capital clause. And the last one is association clause. The last clause is association clause. In association clause, okay, this clause contains the signatories to MOA. When MOA is drafted, no, when MOA is drafted, it has to be signed by the signatories and witnesses, right? And the one, see, this clause contains the name of signatories to the MOA. The full address and occupation of subscribers and witness are also given. The subscribers declare here, whoever is signing the signatory, he will declare that I agree to incorporate the company and agree to take the shares stated against name. Suppose there are, say, how many members I said, if you remember, if it is a public limited company, at least 7 members should sign, I said. So 1, 2, 3, 4, 5, 6, 7 members are signing. A, against A, there are 100 shares. So A is obligated to buy how many shares? 100 shares. Similarly, B, against B, it is written 500 shares. So B is obligated to buy how many shares? 500 shares. So like this, they do promise in a way to subscribe for the shares of the company, and the number of shares are mentioned again in the MOA. So they are giving a declaration that we would be associating this with this company. We will incorporate and get associated with this company. This is the declaration given by the signatories to MOA. This is called as association clause. Okay. Now, see, today we have learned 3 LAQs. One is features of joint stock company. Features of joint stock company, very frequently asked. Then differences between a private company and a public company. This is also very frequently asked. And just now we have learned what is MOA and what are the clauses of MOA. This is very, very easy. We have seen, no, only tabular form. So you can start preparing with this answer first. Focus on this answer. It will easily fetch you 10 marks. Okay. Unlike the other ones where we have multiple side headings and all that, this is very, very easy. So mug up these 9 points, differences between. Just remember these. What you do is you remember this 1, 2, 3. What is 1? What is 2? What is 3? Okay. What is 1? What is 2? What is 3? What is 4? You learn this, and you can draft this remaining content out of your own or on your own, and easily can back 10 marks. Okay. Sure. Then okay, the next one is, if you see in the sequence, I had taken advantages and disadvantages of, we have afterwards, I think. See, we have advantages and disadvantages of joint stock company. I'll tell you one short trick. These advantages and disadvantages come out of features only, no? So if you are perfect with features of joint stock company, whatever good things are there will be the advantages. Whatever negative things are there are the disadvantages. These things we have already done. While doing the features, we have already learned, isn't it? See, what is the first one? Limited liability. The liability of shareholder is limited to the value of shares held by him. Large financial resources. A company can raise finance on a very large scale because it can issue shares to the public, and even when it approaches bank for a loan, a very bigger amount can be sanctioned as loan, and which will enable them to start a very big business, very large, or this thing, operations on a very large scale. Next, continuity. As the shareholders come and go, but the company continues to exist. I told you, under perpetual feature of a company, there, it does not matter how many members purchase or sell shares. There can be exchange of shares, there can be exchange of hands, but the company continues to exist. Then benefits of large scale operation. Since the operations are done on a very large scale, the work can be done very efficiently by investing amount in advanced technology, advanced machineries. Work can be done very smoothly, very efficiently, and also the production cost will come down so that we will be able to compete in the market. Then liquidity. Shares can be easily transferable. I told you there is no restriction. Shares, if I own a share of a company and if I'm in requirement of fund, I can easily sell them and convert them into cash. So transferability is also there, and the companies do enjoy tax benefits. Okay, to promote companies, the government of India gives tax concessions, tax privileges. Okay, so that is one benefit. Then coming to disadvantages. Disadvantage one is there are so many legal formalities. I told you, no, if it is a proprietorship, no legal formalities. Partnership, no legal formalities. But if it is a company, there are so many legal formalities. That is one disadvantage. Then lack of motivation. What happens in case of a company? Owners are different and the management is done by paid up employees. And paid up employees will get salary. So they are not that motivated because their salary is fixed. Whatever profits are made by the company, their salary is fixed. So there is no direct motivation that we should work hard like this. So there is a lack of motivation, we can say. Then corrupt management. Because management is taken care by paid up employees, there are possibilities that they can succumb to some external pressure and can be corrupt. They can indulge in malpractices, dishonest practices. Okay, so that is possible. Then all the statutory rules are to be followed. I told you while telling the features of a joint stock company, all the statutory rules and regulations are to be followed. So that will be a big burden to a company because excessive control, because whatever rules are implied, they have to follow it. They cannot say that we don't go with you. Like say, for example, earlier we had some other indirect taxes, but latest we have from the last 5-6 years, we are having GST. So every company has to apply GST. They have to follow the GST rules and regulations. They cannot say that we don't follow because they are a company registered and they have to follow all the provisions of Companies Act 2013. Lack of secrecy. Since there are so many people, there is a possibility that the secrets of a company can be leaked out. Okay. Then unhealthy speculation. The prices of these shares fluctuate depending on the financial health and dividends future reputation of a company. If the company is prospering, the value of shares will go up. If the company is making losses or there is some personal issue with the managing director or the chairman of the company, even that will affect the price of shares, right? So there is an unhealthy speculation. They may indulge in fake speculation. The directors may indulge in fake speculation. These are the disadvantages. Okay. So today I'll conclude the session here itself. Tomorrow we'll take up SAQs. Okay. Okay, I'm concluding this session here. Please revise whatever we have learned today. Take care. God bless you all. Bye.